Hi students, in this video we are going to see one past exam question on variances. The variances also particularly market size and market share variance. Sometimes students find it a little bit confusing. So I have taken 2021 March-June exam section C question on market size and market share variances. Let's first read the question and then I'll tell you the action plan how we are going to answer this. Medical Temp Company is one of the several agencies in Sictopia supplying medical staff, both nurses and doctors, under temporary weekly contracts to local hospitals. Information regarding the size of the market in Sictopia for the supply of medical staff is as follows. Quarter 1 size of the market for supply of temporary nurses 14 million. In quarter 2 18.9. Size of national market for supply of temporary doctors 8 and 8.2. The increase in national market for the supply of temporary nurses is due to a shortage of full-time nurses in Sictopia. All agencies in Sictopia, including MTC, charge a single market rate for the supply of each type of staff, $1,000 per week for supplying a nurse and $2,000 per week for supplying a doctor. In quarter 1, MTC held 30% of the market for the supply of temporary nurses and 40% for the supply of temporary doctors. MTC uses quarterly rolling budgets. At the end of quarter 1, it prepared its budgeted revenue figures for quarter 2. It based these budgeted figures on the assumption that the company would continue to maintain the market share it had in quarter 1. It also assumed that it would maintain its standard contribution margin of 80% for both nurses and doctors. MTC's actual figures for quarter 2 are as follows. Total revenue from supply of nurses, total revenue from supply of doctors. Actual contribution margin from both nurses and doctors, 75%. Okay, the requirements. Explain why businesses calculate market size and market share variances, 4 marks. Calculate the total market size variance and market share variance, 10 marks. Then there is another company, cheat company, some details, 6 marks. Let's start step by step. Section A. Part A. First of all, let's understand what is this market size and market share variance. We know sales volume variance. What is sales volume variance? That is the impact on profit when actual volume differs from budgeted volume. This is what sales volume variance. But this volume variance can be caused by 2 factors. What are the 2 factors? Overall market itself would have changed. Overall market changes. That means you expected the supply is going to be, say, 5,000 doctors, but actually market demand was 6,000 doctors. Why? There was some market factors changed. Shortage of doctors, something like that. Then the other one, market size did not change. 5,000 doctors is the expected market size. You are also maintaining 5,000 doctors, but your share has increased. Maybe you performed better than the competitors. Earlier you expected 20% of 5,000, but what you achieved is 30% of 5,000. You became stronger than the competitors. The market share increased. Rather than saying increase, let's say changed. So your relative performance compared to your competitors has changed. If I put it in a diagrammatic way, see, this is what the market and let's say this is the share you expected. Market size changes means this circle becomes bigger, overall market becomes a bigger market or smaller market. So obviously, even if you maintain the same proportion, when the market size becomes bigger, you are going to get more sales. The other one, okay, size remained the same, but your proportion increased. Look, this is market share variance. In other words, this is due to outside factors. I can match this with planning variance. Planning variance. Overall market changes. So your plan itself changes due to outside factors. What could be the reasons for market size being changing? Maybe government changes its policies, shortage of labor supply. This is overall market. Market share changes, your performance. This is sales manager's performance, which we call operational variance. So this is what you have to explain for that 4 marks. Start explaining what is volume variance. Then you say that it comes from 2 factors. Either the market itself changes or the market remains the same, but company's performance changes. This is called market size variance. This is called market size variance. This is called market share variance. Market share variance. Finish explaining this. That should give you that 4 marks. Calculate the total market size and market share variance for MTC. Why they say total is there are 2 products. So one by one we will find it and we will add them to find market size and market share variance. I will tell you the easy way to remember the formula. First, understand sales volume variance formula. Basic formula is actual volume minus budgeted volume multiplied by standard contribution per unit. If you are using marginal costing, it will be contribution per unit. If you are using absorption costing, it will be profit per unit. In this case, is it marginal costing or absorption costing? Let me see. They didn't say anything about it. I saw some margin was given. Here standard contribution margin of 80%. Since they are speaking about contribution margin, it must be marginal costing. I don't see a way to find profit per unit. See, all contributions is what they have given. Right. So let's assume it is marginal costing. Actual volume minus budgeted volume into standard contribution per unit is the formula for basic variance. What we do, if the market size changes, in between, I am going to include something called RBV. What is RBV? Revised budgeted volume. Revised budgeted volume. Now, there are 3 items inside the bracket: AV, RBV, BV. Take 2 by 2. Take these 2 together. AV, RBV. This is in the bracket. Outside the bracket, no change. Standard contribution per unit. Then take these 2. Take it in the order 1, 2, 3. So take 1 and 2 together. AV, RBV together. Then RBV and BV together. These 2. So next one is going to be RBV, revised budgeted volume, standard contribution per unit. See, once again, whenever the plan changes, whenever the market size changes, budgeted volume has to be revised. So you get revised budgeted volume. Where do you write it? In between these 2. So now it becomes 3 terms inside the bracket. Take 2 by 2. First, actual volume and revised budgeted volume I took. Then revised budgeted volume and budgeted volume I took. This is market share variance. How do I know? If the actual volume comes, if your actual performance is considered, what is this actually? You are comparing the actual performance with the updated market size. Revised budget and actual are being compared. This is market share. This is what the real performance of the manager is. budget and revised budget are being compared. Look at this. Budget and revised budget are being compared. That reflects market size variance. Market size variance. Another name for this is sales volume operational variance. Operational variance. This is sales volume planning variance. Clear? So this is how we derive the formula. Before you start answering, write this in your rough paper and keep these formulas ready. Now let's start. To answer the question, I need to have 3 columns: actual volume, revised budgeted volume, standard contribution per unit. Then I can find sales, or let's say market share variance, market size variance. Right, we'll start with doctors. Actual volume. Let's go and find the information. Actual volume, actual figures, total revenue of supply. Okay, they have nurses first. Let's write nurses then. $5.3 million. They said the price they are charging is 1,000 per week. Here, 1,000. Charge a single market rate for the supply of each type of staff. $1,000 per week for supplying nurses and $2,000 per week for supplying a doctor. MTC's actual figures for quarter 2 are as follows. Total revenue of supply is 5.3. Simple. Revenue is given 5.3 million. Divide by 1,000. 5,300 head weeks. That means one nurse, 1 week working as counted as 1 unit. So 5,300 such units have been supplied. Doctors, 3.6 million. They are charging $2,000. $2,000 per week for a supply of doctor. So actual volume is 3.6 million divided by 2,000. Done. Now let's see budgeted volume and revised budgeted volume. This must be the budgeted volume, 18.9 and 8.2. This is the market size. Let's see, information regarding the size of the market is as follows. Yes, this is the overall market size. Of that market size, they have 30% market. Sorry about it. Yeah. So see, quarter 1 market size 14 and 8. They are using a rolling budget. Rolling budget means what? Based on quarter 1, you decide the quarter 2 figures. So what are these figures? This is the updated one. They say at the end of quarter 1, prepare this budget revenue figures. Quarter 2, it based these budgeted figures on the assumption that the company would continue to maintain the market share it had in quarter 1. So you are going to have the same numbers of quarter 1 for quarter 2 as well, since you are using the rolling budget. So let me have a market size calculation, or straight away we can do in one shot. Look at this. Budgeted volume would be nurses. 14 million is their quarter 1 market size. The original budget would have remained at the same size for quarter 2 also. So 14 million divided by 1,000. Look at this, 14 million divided by 1,000. What is this? This is the overall market size. How many nurses are being sold during the during the quarter by the companies in the industry. Overall market. Right? This is the budgeted volume for the market. Of that market, what percentage is sold by this company? 30% of market supply of the nurses. Can you see? 30% of the market. So, this multiplied by 30% should be our company MTC's budgeted volume. Similar working for doctors, 8 million is the overall market size. All the companies are charging a price of 2000. So, when you divide like this gives the market size. Doctors market, MTC maintains 40% share. Here 40% of supply of temporary doctors. This is the original budgeted volume. However, due to some changes, due to some shortage in the supply, they say Q2 figures are now expected to be this. So, the revised budgeted volume or after the change in market size, this is what the market figures are. 18.9. Bring it here. 18.9 million divided by 1000 to get the overall market size after the revision of that 30%. 30% because they didn't revise the market share, they revised only the market size. Then new market size for doctors 8.2 million. 8.2 million divide by 2000 to get the number of units, 40% market share. Clear? This is based on Q1 figures. I prepared the original budgeted volume. Then there had been some changes in the market size. So, this gives the revised budgeted volume. Standard contribution per unit is very simple. They say 80% share. Don't take this 75, this is actual. Here 80%. It also assumed that it would maintain its standard contribution margin of 80%. So, selling price 1000, 80%. Selling price 2000 for doctors, 80%. Market share variance, remember the formula I showed you, actual volume, revised budgeted volume. Actual volume minus revised budgeted volume into contribution per unit, 296,000. Copy paste the formula for doctors, this total this is the market share variance. So, if you look at the numbers, even though they didn't ask the interpretation, the operational variance, the performance of the company in the case of nurses, it is low. They have kind of lost their market share. They don't have the market share that they expected. The performance of the company is weak. Whereas doctors, it has gone better. They have performed better. Market size variance, both should be favorable because market size increased for both. Favorable, get the total, favorable. So, this is adverse, this is favorable. We know that minus is adverse, plus is favorable, but still better to mention in the answers so that any confusion is avoided. Clear? So, that would have been much easier calculation if you followed this approach of formula. Market size variance, how we find it, market share variance, how we find it. Use this approach. Now, let us see whether we have answered the requirement. Calculate the total market size and total market share variance. Only the calculation, they are not asking for interpretation. 10 marks, good, we have done that, very good. Now, the market size and market share variances have also been calculated for Q2 for one of MTC's competitors, Cheat Company. These variances are as follows. Market size 185 adverse, 724 adverse, and market share 1065 favorable and 1043 favorable. Totals are given. This is a different company, completely different company, but in the same industry. Cheat Company holds the same percentage of each market as MTC. It also uses rolling budgets and prepares its budgeted revenue figures using exactly the same assumptions as MTC. However, when Cheat Company's sales director had to provide the market size figures for quarter 2 to the accounts department. They deliberately reported these figures 30% lower. Okay. See, when they are revising the budget, he deliberately reduced it by 30% by excluding the market segment relating to maternity units. The accounts department was unaware of this. Discuss the actions of the sales director at cheat company and how this may have impacted on the variances which have been calculated. Okay. Now look, we have formulae like this. What? Actual volume, revised budgeted volume into standard contribution per unit. This is market share variance. Market size variance is revised budgeted volume minus budgeted volume into standard contribution per unit. So what this guy has done, deliberately he has understated this figure. Quarter 2 market sizes, when he was revising the budget, when he was giving the new numbers, he has understated these figures. What will happen to the market share variance? Now, market share variance, since this is going to be understated, that will become more positive. Why? The subtracted figure is less. If you think logically, you are giving a lower standard now. You are showing the target to be a smaller value, right? So, this is going to improve or improve the variance. But is it a right thing to do? No, because deliberately skipping one particular market segment and giving the market size is not right. It is not right. It's a fraud. Whereas market size variance, when this is smaller, imagine the first figure is smaller, means it will become negative. So, it will become weaker or lower. It will become adverse. This will become favorable. But remember, market size variance, what do we say about market size variance? It is caused by external factors, market size changes. So, the sales director is not responsible for this. It's called planning variance. So, this being adverse will not affect the performance, will not affect the bonuses of this manager. He doesn't care about it. What he cares about is market share variance. His performance is measured based on market share variance only. Do you understand? So, this is what we have to explain here. What are we going to say? I will give it in bullet points, but you have to write it in paragraphs. What? By changing the revised budgeted volume, by giving it as a lower value, market share variance will become favorable, further favorable. This will give market size variance adverse. It will increase the adverse market size variance. First explain this. Then you have to explain the performance of the manager is based on share variances only, not the size variance, because that is external factors. We don't include size variance in the performance of sales director. So, size variance will be excluded. Only the market share variance is going to be considered. Then you say, this is not right. This is fraudulous. Purposefully avoiding the inclusion of one market segment in the budgeted volume just to show better figures is not right. If you explain this, that will give you that 6 marks. Right. I particularly chose this question to be answered, especially the calculation 10 marks, because many students don't know this approach of answering, how to derive the market size, market share variances. Very simple. You write the sales volume variance formula, put the revised budgeted volume in the middle, then you will have actual volume, revised budgeted volume together, revised budgeted volume together. Take it in this order. 1 and 2, 2 and 3. Outside the bracket, same figure. If it was absorption costing, I would have used profit per unit. This is marginal costing, contribution per unit. That's it. Very simple, 10 marks. So easily, within the limited time, you should have been able to score that. Please practice this. We will meet up with another question in the next video. If you have any specific questions that you don't know how to answer, you don't understand, please let me know in the comments. I will answer them in the next videos. Also, subscribe this video and share it with your friends so that everyone can benefit. Thank you.